Welcome to TheoTrade. This is Don Kaufman. It's April 11th, 2025. We have just about an hour to go to the cash close here on this Friday afternoon. S&Ps, they're up 72 right now, but people, that simply does not matter because this has been a marketplace from rally to rollover. It has been the whiplash week from hell in this marketplace. So obviously we're going to cover some of the price action here in this TheoTrade weekend update, but there's so much more going on. We're going to give you a bit of a ETF sector update because sometimes you just get lost in the volatility. We're actually going to look at volatility itself, which is pretty shocking. If you're looking at VIX, you're doing yourself a huge disservice. There's a lot more going on. We're going to look at the bond market. We're actually going to look at bond volatility. We're going to look at the US dollar and the implications there. And ladies and gentlemen, we have liquidity issues, significant liquidity issues, and I'm going to cover that. Let's get started here again on the TheoTrade weekend update. Let's start with the SPX. Oh, sometimes you kind of get lost in the volatility. And by that, I simply mean it's like, this marketplace, we were down precipitously last Friday, closed basically on the lows. It's funny because like last Friday seemed like a year ago. Like if you traded it all this week, like last Friday literally felt like it was a year ago. Like it was like on a different planet. Okay. Monday, that was the only day that, the volatility was what? It was totally extreme on Monday. Okay. We sold off, we rallied, we ended up the day massively unchanged. But Tuesday, okay, after a rip and rally back, we faded hard on Tuesday. Obviously, Wednesday was, we're going down until the, big fun tweet came and we actually went where? Right to the upper edge of the expected move. To me, Thursday was the most wild that we sold back off after that. And here we are on Friday. Yes, we are finishing this week higher. Okay. And we are finishing this week substantially higher, at least at this point. But it's got an hour left, right? We're very close right now to the upper edge of the expected move. And what's just wild, the expected move, there's 350 points from here. Okay, to here is roughly 350 points. And the craziest portion of that, we were almost unchanged as of yesterday. And here we are, again, almost 350 points higher. It's funny because a moment ago I was saying like one of the least important things on the screen right now, when you look at the S&Ps, like it just doesn't do you justice. I mean, you were trading just earlier today, a few hours ago, we're trading at 5260. Just again, behold. 5260 a few hours ago. Here we are right now, closing in on 5400. Yeah, what? 140 S&P points amongst friends. 140 S&P points amongst friends. First of all, the expected move for today, ironically, okay, is even higher than that. So we were anticipating this kind of movement today, and it's all kinds of chaos because you got to recognize when you open up like a 180-day 4-hour, okay, and you see all this volatility, we had months of trading where you didn't move, okay, 130, 140 points. Now you're doing it in a couple of hours. And it's creating some pretty significant issues for this marketplace, which I'm going to go into some detail because if you do trade, if you invest, you have to understand we got issues right now. We got liquidity issues. Let me actually begin, though, to some more detail with a little bit of an ETF sector update. And I just wanted to do this just to give you a quick feel for what's really going on out there. Okay. So when I talk about sectors and so forth, like XLK, obviously technology, on a year-to-date basis, down about 14%. XRT, okay, this is one of the retail ETFs, down about 17%. Okay, XLB, which is materials, down only 3%, faring rather well. XLP, this is an interesting one, consumer staples. That's actually up almost 3%. By the way, I happened to put on a short position in there, given the fact that we had a consumer sentiment survey that was like The second worst consumer sentiment survey basically since the 1950s. Gotta love that. Like, I don't even get into the consumer sentiment survey, but I do appreciate that it was that bad. I think that this is just a sector that's held up extraordinarily well. And the XLP, it's got stuff like Walmart in it. It's got some Costco in it. Okay. Here's healthcare. Healthcare basically unchanged in the year. Okay. SMH, it's just semis, down about 18%. Here's the utilities, massively unchanged. Okay. This is industrials, down about 4%. XLY is really Amazon mixed with some Tesla. Okay, it really doesn't have to do, like, people get into this like consumer discretionary. Yeah, well, it's loaded with Amazon and Tesla, and of course the home builders down about 12%. And you're kind of surprised that, at least I am, after all of the volatility that we've been through. Okay, and you start looking at the sectors and you start looking at the S&Ps. Let's look at the S&Ps for just a second, a year-to-date basis. Down about 9%, whereas the QQQ, the overall NASDAQ's down about 11%. You would think, okay, given some of the volatility, that this it felt like the end of the world this week. But net, yeah, the spiders, okay, they're down 8%. And, from my perspective, and again, I'm going to put my perspective and a little bit of opinion in here, okay, that's not that bad given some of the volatility we've seen. We've come off some of those lows very, very nicely. If you look at the SPY at one point, earlier this week, this thing was down almost 17%. That's a rip and rally. So some of the risk has clearly abated. Maybe. And that's exactly what we're going to get to next, is that, yeah, we're down 8-9%. It was a nice recovery off the bottom over here. But the question that everybody has, and it's a fair question, okay, what's coming next? Because, this was Whiplash week, but what's next? Well, what's next from my perspective, okay, is a little bit disconcerting. The volatility. Now, most people look at VIX, okay, and that's fine. You want to look at VIX, look at VIX. Well, look at VIX. The VIX is coming down a little bit, not that much, okay? And what bothers me about it isn't so much the VIX, and this is why I was like, I don't like looking at the VIX. The VIX is an equation, and it's an equation based on 30-day, okay, volatility in the SPX, okay? What bothers me is that the volatility futures are not really coming down. And a lot of people have a tough time kind of understanding like volatility futures. In fact, the ones that really matter right now, I'm actually going to freeze the screen. The ones that really matter, okay, are right here. Like May volatility futures, they're actually higher, okay? Stop right there for a second. Let me ask you a question. How many times, okay, have you seen a marketplace, and some people are brand new and they've never even looked at these things before, but how many times do you see a marketplace up almost 2%? But one of the most pivotal volatility contracts is actually higher. Usually when markets go up rambunctiously higher, volatility does what? It drops, okay? And it drops substantially. So whether you look at the volatility futures or whether you look at VIX, even VIX, you're like, oh yeah, man, VIX is down today. Really? Because VIX is down like 5%. Market's up like 2%. VIX should be getting crushed, killed, but it's not. Evidently, we see some risk. And that's one of the points I really want to drive home to you. Like, if there's one thing that you pick up, okay, on this update here, is that VIX, volatility futures, and now VVIX is down, not even but 3%. Doesn't even make sense. When you actually look at the closing price of VVIX, now, some people don't speak VVIX geek. I'm going to speak VVIX geek for you. Anything above this 110 region down here, okay, is when you get under your desk and start rocking back and forth and, screaming like, put your helmet on, mom, whatever does it for you. That's above 110. We're in Never Land. We're trading like 152. And this is the area that really bothers me. What the VVIX displays, whether you understand this product or not, it's the volatility of VIX. Okay, if you trade options in VIX, okay, you're going to influence this VVIX. What it indicates, and that's the bottom line, what this little guy indicates, okay, is that the professional world, they're not giving up their hedges. They're not lying down their weapons, okay, for volatility. Like, if this is a weapon used against volatility, why aren't they putting it down? They're not, okay? That is one of the most important things that you can actually grab from this weekend's update, is that I don't care that the market's even up 2%. I don't care, okay? I mean, they can go much higher. They're going to possibly go higher. Maybe that's what it's going to take for volatility to subside, but it won't subside right now. And for those of you that understand, first of all, this can be incredibly, incredibly opportunistic because you got a marketplace that's rallying. You might be able to sell volatility into a marketplace that's like elevating, yada, yada, yada. At this point, okay, we don't actually have clarity as to why the volatility won't come down, other than to say, okay, the professional world isn't putting away their hedges, neither will I. I just, that's, look, it's game on still. It's absolutely still game on for volatility. Next in the docket. Talk of the trading community, of course, has been the bond market. Okay, I'm going to mix right into there the US dollar. The US dollar is a little bit recovered from some of the lows this morning. I mean, this got insane, just insane. If you look actually at like the euro, okay, I mean, it's just wild. The US dollar is getting absolutely killed, which, look, you can argue all you want here, okay? What it's effectively doing, it's just bleeding more volatility back to the equity market. Same thing is true of the bonds. There's a lot of conversation of what's going on in the bonds, okay? Some people are like, well, but it's US debt and we're just not comfortable right now in the US. And okay, please, because in the end, if this marketplace around the world comes apart, where are you going to put your money? And I'm not saying that facetiously. What are they going to do? You're going to buy dollar and you're going to buy bonds. So I just don't want to hear it. This is a trade coming apart. I've heard people say like, well, people don't want to buy US debt right now. You out of your mind? Like the US debt's actually paying quite a bit. This thing's back up to basically like, it hit 4.5, 4.6%. Like that's not bad. At some point, people are going to look at this because this is the argument that I heard earlier today. People just don't want to buy US debt. They don't believe in the US anymore, really. Okay, because I will take 4.5% over the crap fest of a marketplace that we've been in. That's how easy it is. Like that's why I don't buy it at all. Okay. If you are looking at the bond market, the easiest thing to say, hey, maybe the interest rate does go higher. This is the 10-year interest rate. And again, 10-year interest rate hit about 4.5%. And you look at it and you're like, look, eventually people are going to be like, I'll buy that. These bonds are going to be like, I'll buy that. Why? Because the bonds could actually pay 4.6, 4.7. Maybe they even get to 5%. Let's get crazy. They get to 5%. They could. But what would you do? You might be like, I'll take the 5%. Okay? Because it's that or get thrown into Mr. Toad's wild ride. So some people are going to allocate capital into the bond and into the note markets. They will. They'll allocate some capital into it. There's no question about that. So the bond volatility right now, it's nerve-wracking. It will end. It's nerve-wracking, though, because some very big firms are kind of coming apart at the seams a little bit in there. Nothing more, nothing less. I think that the bond volatility, though, will calm down. There's actually kind of a crazy way to look at this, too. If you look at like the TLT, go over here to studies, go add study, go to volatility studies, up to implied vol. Okay, now I'm actually going to get rid of equities, show volume subgraph, hit apply, hit OK. I got rid of the volume in there. I just wanted to show this. I was actually looking at this while live this morning on TheoTrade, but look at like 15-year volatility. But here's actually the best one. Let me look at the max chart. Okay, I just want you to see how wild this is. Bond volatility has actually gotten. Okay, we have one of the biggest peaks ever of bond volatility. The only one that really eclipses this, you have to come all the way back to the financial crisis. And it's really weird to talk about this, but some of the rally and some of the liquidity issues, we haven't seen this stuff since the financial crisis. That's how wild markets actually got this last, couple of days. I mean, and again, I was saying, the S&Ps are up 100. Who cares? There's still 45 minutes to go. They could be up 200. They could even be down 100. Okay? That's the kind of world that we live in right now. Now, onward from there. So the bond markets, they will recover. They may still see some sell side activity though. And if they do see sell side activity, I have absolutely no problem saying I, am selling bond puts. I am selling bond puts. And I'm starting to get, pretty excited about the project. Like I would buy the bonds at 108. I'd buy them at 101. I'd buy them at 98. Let's get crazy. Put them to me. Why? Why not buy the bonds there? As I said, like at some point, when they're paying 5, 6%, like can you imagine 6% of the 10-year? Take that all day long. So don't necessarily look like, the Fed needs to save me. I'll tell you what, higher interest rates will save you. because people will have enough of the stock market volatility and they'll move into the bond market, okay? And the bonds will actually calm down. As soon as people start buying those bonds again, well, they're going to rally, okay? And that volatility will start to come off a little bit. So bond market volatility is wild. Obviously, the US dollar is being implicated in this. And the US dollar, I brought it up a moment ago, and there's just huge sell side activity. And then, of course, everybody's looking at the gold market and they're like, oh, look at gold. Gold is a function of the dollar getting killed. Here's another possible opportunity. And this is going to sicken people when I say it. But when you start looking actually at the opportunity in gold, okay, this is actually one of the larger breaches we've actually seen, okay, in any recent history of gold to the upside and outside of an expected move. I've been tracking expected moves in gold pretty much, for what, 10 years. And that's a magnitude unlike we've ever seen before in terms of a move to the upside. So opportunistic, possibly. Okay, I'm going to wait another day or two to see actually how some of the bond volatility kind of plays out as well, and the dollar volatility kind of plays out. I'm going to get through this weekend, but if we continue to the upside in gold, okay, I'm actually going to step in and short this because I don't need a big pullback. I just need a little bit of a pullback, and that little bit of a pullback can be a lot of bit of a profitability. All right, push all of that aside for a second. So I can't stress enough, the sector update, things could have been a lot worse this week. We got through by the skin of our teeth, okay? I mean, these S&Ps are up. And again, we'll look at the SPX one more time over here. You're just about, 300 plus points higher on the week. So it's a marginable rally to what could have been absolutely devastating week. I say marginable, but 300 points. What's 300 points amongst friends? And one of the days you obviously had over a 10% rally in here. All of that aside, this is the part you're not going to like. This is the part when I say none of it actually matters. And I'm going to show you exactly why it doesn't matter. We have liquidity issues. And a lot of you are not really familiar with liquidity issues. And I'm not saying that to be, definitive. Most retail traders don't understand market liquidity. First of all, okay, we are seeing widening out of bid offer spreads. There's no question about that. The higher the volatility, the more your bid offer spreads are going to widen out. Even stuff like Microsoft. Just make a quick point. Even stuff like Microsoft. The bid offer spreads in here are like 20 cents wide. That's ridiculous. It's just ridiculous. Because the volatility, bid offer spreads widen out. But I have been pleasantly surprised by products like the SPX. Okay, look at SPX, like these short duration options. These things are still making 30 and 40 cent wide markets. It's pretty phenomenal for a $5,300 product. The reason I said, though, that I don't really care that the S&P's rallied and kind of push that aside for a sec, whatever, they're up 300 and something points. Yeah, here's the part you're not going to like. Go over to Active Trader with me. Okay, ladies and gentlemen, I am now going to freeze the screen. There it is. It's frozen. Okay, so I froze the screen on purpose because I want you to see this is the S&P futures. Okay, and the S&P futures are obviously used as a hedge, but they're basically, this is finance, okay, 101 here. This is what drives order flow to the entire marketplace. Like this is the place that people come to hedge. This is the place people fire first. The entire professional community is watching the S&Ps. And I say finance 101. I don't mean that the basics of it. This is, okay, the place that the marketplace goes to mitigate exposure. So what's the issue? The issue is, look at the product depth. That's why I froze it, the bid size and the offer size. Okay, look at the product depth. There isn't any. Most of the time, for those of you that have experience who probably know this, there's usually what? Sometimes hundreds in here on the bid and on the offer. There's no liquidity whatsoever. Most of today's trading session, I mean, the S&Ps are up 90 right now, but most of today's trading session, the depth of the marketplace was single digit. Let me unfreeze it for a second. I'll unfreeze it for a second, lock them up again. There we go. See this? Single digit. You go, so who cares? What do you mean, who cares? There's no depth to the marketplace. If right now you wanted to trade 50 S&P contracts, okay, there's many minutes go by where you're doing 5 to 10,000 contracts a minute. There's no depth to the marketplace. Who's going to absorb all that? There's 9 contracts offered here. Oh no, okay, or 12 on the bid, 8 on the offer, 13, 15. There's no market depth. less than $1 million right now could actually move the S&Ps more than a point. The market making firms are not actually stepping in with size. They're stepping in with next to nothing. It's insane. It's absolutely insane. That's why I'm telling you, and I say this without hesitation, unequivocation. Okay, look at this. There's 3 on the offer right now. 3 lot. That's literally like, Captain 1 lot rides again. Nobody wants to put up any size because they are so deathly afraid of getting whipsawed right now. This is bad. It's really bad. That's why I said you could be up 100. No one gives a damn, because what can happen is all you have to have is a size trader come in. This thing's going to, like, if I wanted to go out right now and I wanted to sell 1,000 S&P contracts, okay, 1,000. And I'm going to tell you right now, I have traded, okay, more than that in a few minutes. I worked for a good sized firm years ago, but I've traded more than that in a few minutes. I would absolutely, okay, rock this marketplace. And you start looking on an intraday basis, okay, we're still doing right now almost 2,000 contracts a minute. How are we even doing 2,000 contracts a minute? There's like no liquidity out there. That's why the tape is totally sketchy. It's jumping around. We're not even trading linear anymore. We're like 98, 99, 105, 102, okay, 91. It's all over the place. There is no depth to this marketplace. So what you have right now is you have a high volatility situation, okay, where no one wants to really step up. And I'm going to freeze it again. Nobody really wants to step up, okay, and make deep markets. Again, many of us have actually looked at this for decades. There's usually like 210, okay, 120, 120. There's no size here. There's none. So if any big player does come in, look at this, 3, 9, 9, 7, 9, okay, any big player comes in and has to do real size, they'll absolutely decimate this marketplace in seconds. And the opposite is true. You can trade to the upside. That is, to me, a structural issue of this marketplace that needs to resolve itself. The volatility obviously has to calm down, but there's a confidence factor in the marketplace, okay, that got dislocated. It needs to come back. Look, throughout the course of this week, the kind of volatility that we saw runs beautifully for the trades that I do. Took off almost everything I had on profitably. I mean, I had trades on Costco out profitably, XLE out profitably. Okay, it just goes like the list goes on and on and on. I, again, also got a couple of good trades on trading Bitcoin ETF. Okay, new trade in XLP, as I was talking about a few moments ago. But all of this, again, it's a fight. It's a fight in wider bid offer spreads. So you got to pick and choose your entry very, very carefully. Now, what are we looking at into next week? Okay, into next week, the first thing I'm going to tell you, okay, of course, you guys can cruise over to the calendar and you can start looking out at the calendar like, oh, what does next week hold? First of all, Friday is a banking holiday. We're closed. The markets will be closed for Good Friday. That's Friday the 18th. Okay, as you kind of back up a little bit on the week, all of the different announcements that are going to come out, I'm telling you right now, don't really make any bit of difference. Okay, the earnings right now, push them aside. Volatility is going to take precedence. Trade itself is gripping hold here, meaning that, like, let's see if the trade calms down just a little bit inside of the bond market. Maybe volatility starts coming off. Maybe that some traders start relinquishing some of the hedges. Obviously, coming off of a week where we had like a $350 expected move. But what's next week looking like? Okay, next week, you're at about $240 right now. Before you get all hopped up, you're like, yeah, it's a pretty big drop in volatility. Yeah, but it's also a 4-day trading week. So you're missing a day, yet you still have $240+ of expected move. It's a big number. Throughout the course of next week, you're going to be trading in the equivalency of like a 43, 44 volatility. That's what next week looks like. It's also, okay, a primary expiration. It's the monthly expiration of many of the options, which is going to make it, again, that much more, okay, rides on next week's trade. So kind of summation over here. Yeah, the S&Ps, they're up right now. They're up some 2%. Let's see if we can hold it together. Even 35 minutes to go to the cash close. Let's see if this marketplace can hold it together. Okay, it doesn't necessarily matter where the S&Ps are right now. It matters when we start seeing volatility truly back off, We need to make and substantiate, okay, huge drops, not just in these vol futures, but in the VVIX. I'm talking huge drops. Get back down to that 110 region in the VVIX. Let's see some of the this wild backwardation abate. I mean, you're looking at a volatility future right now. You're coming into a weekend, and this thing is actually higher coming into a weekend. Wild, wild moves. Again, Whiplash week, more in store next week. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.